Hi, my name is Dan Brownell. I'm a senior underwriting consultant at Munich Re, and today I'm going to talk about financial ratios, or more specifically, I'll cover some useful profitability ratios, also sometimes referred to as income ratios. The ratios I'll cover can be applied to both the public and private sectors, and for the most part, they are basic and easy to calculate. Profitability ratios help to provide an understanding of a company's ability to generate earnings, profits, and cash flow, utilizing resources such as sales, assets, and equity. Some common examples of profitability ratios used during underwriting include profit margin ratios, return on assets, and return on equity. All of these ratios can provide an indication of how well a company is performing at generating revenues or profits. For most of these ratios, a higher value is desired, as a higher value indicates a company is doing well and generating the all-important profit. However, these ratios should not be viewed in isolation. To be meaningful, they should be analyzed in comparison to ratios from prior periods of time and in comparison to industry competitors. Profit margin analysis includes different levels of profit or profit margins. A couple of useful profit margin ratios are the gross profit margin and the after-tax profit margin. Gross profit margin is the ratio of gross profit, or gross sales minus cost of sales, to sales revenue. It is the percentage by which gross profits exceed production costs. Gross profit margin is a good indicator of how profitable a company is at basic level by showing how efficiently a business uses its resources. It is usually expressed as a percentage, indicating the profitability of a business before overhead costs, and as a measure of how well costs are controlled. Measured on a historical basis, it is used to compare results with peer companies and the industry. There can be some variance in results within industries and sometimes even among companies in the same industry. The net profit margin ratio, also referred to as the after-tax profit margin, takes the net income after taxes and divides it by the total revenue or sales. It is displayed as a percentage and helps you determine how well the company is handling expenses by measuring the profit generated by each dollar of sales. It can be a clue for an underwriter in determining how effective the management of a company is at controlling expenses, especially when compared over several periods of time. The after-tax profit margin is another key ratio of profitability that is used to compare companies in similar industries, but again, the results and their significance can vary among industries and to some extent among companies in the same industry. Return on assets measures how profitable a company is relative to its total assets. It illustrates how well a company is using its total assets to make a profit. The higher the return, the more efficiently the company is using its assets. If comparing to similar companies, it's important that similar product lines and business types are involved, as the size of the applicable asset base is significant in determining the relevance of the results. The ratio can vary widely across different industries, in particular between capital-intensive, large asset-based companies and non-capital intensive companies. The return on equity ratio, or ROE, measures the profit earned on the money invested in a company's stock. Return on equity is determined by dividing net income after taxes by average stockholders' equity. If a company has preferred stock, the dividends from that must be deducted from the net income. The higher the ROE, the more efficiently the business is utilizing its equity. Having net income increase in relation to increases in equity presents a favorable picture for a company. Thank you for your time. We hope this brief review of profitability ratios will help you in your evaluation and underwriting of business cases.